So it was a perfect timing because I was able to invest in real estate full-time, heavily, while at the same time exercising my entrepreneurial skills and my love of business and entrepreneurship to turn it into a business to help other people do exactly what I was doing from 2,000 miles away in Southern California, investing in Florida, Georgia, Michigan. So that's how it all kind of came to a head.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How we doing?
Oh, we're good. We're hanging in there. We have, a nice day ahead of us. Some recording, and that's about it. Other than that, hanging in there. Just another day, another dollar.
Yep, absolutely. I'm going to jump into it because we were a little late getting started, and I don't want to cut our time short. But I'm excited to have our guest on today. I think we're going to have some really great discussions. Excited to hear his story and learn from him. So with that being said, Marco, thanks for joining us, bud.
Hey guys, it's an honor to be on your show. Thank you very much. And I'm looking forward to our conversation today.
Yeah, absolutely. So you want to kick things off, just tell everybody a little bit about you, your background, your journey, and what you do.
Well, it's a long story. I'll give you the executive highlights. Basically, I got into real estate investing at the age of 18. As soon as I could qualify for financing is when I really bought my first property, and the writing was on the wall. But just fast forward to more recently being 16 years ago, I decided to go into real estate full time. And in a 9-month period, I had purchased 84 units. That was at a time when credit was a lot easier to acquire than it is today, since post 2008. But people were coming to me all the time and saying, hey, could you mentor me? Could you coach me? I see what you're doing. You're kind of tearing up the world. I need the help. Well, I was going to a bunch of boot camps at the time, and I was meeting literally hundreds of investors. And in the process of them asking me for assistance, I was basically saying, no, I don't have the time for it. I apologize, but I see a lot of deal flow. Why don't I just pass on these deals to you? And that was the light bulb moment. That was a time when I realized, hey, people are spending literally tens of thousands of dollars on education back in the day, but they still weren't pulling the trigger, and they needed help. And really, I didn't want to be that quote unquote guru guy in the middle. I wanted to be the guy that was out there looking for markets, looking for deals, buying them myself, but also passing them along to other investors. But being an entrepreneur, and I've been an entrepreneur since I was 13 years old, I just turned it into a business. And I said, hey, I'm going to just turn this into a model. And then I marketed the crap out of that term turnkey. And so even though it existed, it was really just, all out on calling it turnkey real estate investments and turnkey real estate investing. And so 16 years ago, I marketed the snot out of it. And today everybody kicks it around. Unfortunately, today people use it differently. Some people call turnkey something that it isn't. And it kind of bothers me. And we try to define what it means. But in a nutshell, that's my story. I just started at a young age. I was teaching myself everything from real estate to entrepreneurship and carried it through into my adult life.
Awesome. I love it. I think it's interesting because I actually just had a conversation with a buddy who's thinking about buying some turnkey property. And he was like, I think it's interesting. I can buy it. And it's just whatever. And I said, hey, before you get into that, I said, when you research companies, not every turnkey company is the same. The services and the stuff they provide can vary very differently from one to the other. They might just basically be flipping a property to you with management in place, and they're not going to manage it themselves. They might just be wholesaling a deal to you. They might be doing a complete renovation gut job. They might be managing it for you afterwards. There's a lot of different variables that come into play. And I think it's very important when people start going down that rabbit hole and looking at that option, that they understand that turnkey does not necessarily mean one thing from company to company to company. So I can understand some of the frustration from your side, because I'm sure a lot of times you talk to people and the expectation they have can be different than what you perceive it to be or what you even offer to people.
Yeah, the thing is some people use the term turnkey and they're really selling what I call rent ready. It's something that has capital expenditures coming up, or maybe it has deferred maintenance items on it. And sure, yeah, there may be a tenant in there and it's cash flow positive, and it may also be professionally managed, but I don't take that as being fully turnkey. Turnkey to me means that you're buying something that's new or like new in a good market, in a good neighborhood, and we can define all these things further. But it is, there's no deferred maintenance, it's cash flow positive, it's professionally managed by full service property management. And the experience that goes around that is what I refer to as the turnkey real estate investing experience, but that's all one package. So I don't want a client buying a property, or I don't want you buying a property that you're going to have problems with, you know, in the first 3 months or even in the first year. Now things happen, granted, you know, people lose their jobs and whatever else, but that's not a problem with, you know, investing in turnkey. That's just, you know, life. That's just a human problem.
Yeah. No, so I do definitely want to get into that, but I want to take a half step back, go a little bit deeper into you. So you said you started at 18. I don't want to date yourself too much, but when was that?
That was, oh man, that was about 30 years ago. Something like that.
Interesting. Yeah. And the reason I asked that is because we'll probably get to the topic at COVID at some point. And I think it's always interesting to see how people who have experienced one or multiple cycles are viewing what's going on or different things, because myself and John, as we always talk about and say, you know, we've only experienced the upper, you know, the portion of the cycle that goes up. We've not yet experienced a full cycle or even multiple cycles. So it's always interesting for us to have that perspective from somebody else. So for anybody listening, I just wanted to make sure they knew, and it's good for me as well. So how did you transition going into full-time? Because I always find that interesting.
Yeah, so that's a story in and of itself. In 2008, I joined my, I call him my cousin in quotes just to simplify things, but my cousin and another partner. We were the three co-founders of essentially what you might call a dot-com business in 1998. And we had raised $9.5 million of venture capital funding to build this business, which was essentially like the Costco of the club industry. And I'm referring to country clubs and golf clubs. So things were going well. We had 105 employees. The company was growing. We were, you know, making a big splash around the country. And then the NASDAQ crashed. I don't know how old you guys are, but you seem pretty young. But I don't know if you remember, you know, when the stock market crashed, that was one of the crashes, you know, over the last 100 years, of course. But that basically took down a lot of tech companies, and that was what they referred to as the dot-com bubble. So when that stock market crashed, our venture capital funding dried up, and we couldn't continue to pay our employees. I mean, our burn rate was $100,000 a month. And so a lot of companies failed. I don't know if you guys are old enough to remember pets.com. Do you remember, you don't remember pets.com? Man, they were advertising everywhere. Just go to Google and do some research on pets.com. You'll just see all the nuttiness that was going on back then. But the problem was there were so many companies that were very, very well funded by venture capitalists that were not cash flow positive. And they failed, you know, because if you have a recession or you have a stock market crash, if you can't sustain yourself and carry yourself because you've got positive cash flow, you're going to fail. And unfortunately, we weren't in a position where we were profitable. We had revenue, but we weren't profitable. So we had to close the doors, and I had to lay everybody off. So I was the third partner. I was the third person in, and I was the third last to leave. But that vision of having, you know, being a dot-com millionaire, which so many, especially young people, you know, call them kids, but a lot of young people just had these visions and dreams of being millionaires overnight, and a lot of them did, but it just vaporized like that. So I fortunately was already investing in real estate, and I had some savings and reserves that I could, you know, weather through a pullback in a recession like that. So I took some time off. I took about a year and a half off, and I didn't do anything really. I just took time off. I didn't want to go back into corporate America. I didn't want a JOB, you know what they call JOB, just over broke. So I didn't want to be in that situation. I was always an entrepreneur. I wanted to continue to be an entrepreneur. And so I thought, well, hey, I'm going to marry. I first of all started investing in real estate full time. That's how I made the transition. I just realized, hey, you know what? I love real estate. This is what I want to do. This is what I know. I'm going to continue doing it. But the timing was interesting. You guys probably aren't old enough to remember an author by the name of Robert G. Allen. If you went to Amazon, you could Google his name, Robert Allen, and you could find him. He's authored probably 20 books, some with Mark Victor Hansen, the Chicken Soup for the Soul guy. But he was one of the godfathers of nothing down real estate. Anyway, I don't know how he got my email address, but I received an email from him and his organization saying that they're putting on this free 3-day event, in September. Why don't you come, type of thing. So I thought, I got time on my side. I signed up, went to this event. There were 2,000 people in this massive ballroom. But the event was amazing. The content was phenomenal. Like, you were riveted to your seat. It was so good. But of course, it's a free event. So they're selling something in the back of the room. And what they were selling were $15,000, $25,000, and $35,000 boot camps that were peppered all around the country. Having time on my hands and following the other hundreds of people running to the back of the room, credit card in hand, I did the same thing. That was the turning point. That did two things for my life. One, it put me back into real estate, but real estate investing on a full-time basis. And number two is what I had mentioned before. The investors coming to me, so-called investors, but the students who wanted to be investors coming to me asking for help. So it was a perfect timing because I was able to invest in real estate full-time, heavily, while at the same time exercising my entrepreneurial skills and my love of business and entrepreneurship to turn it into a business to help other people do exactly what I was doing from 2,000 miles away in Southern California, investing in Florida, Georgia, Michigan. So that's how it all kind of came to a head.
Love it. I think it's interesting. It sounds like there's a lot of parallels between the dot-com crash to today. I mean, the amount of people that are getting funding in VC and angel companies and unicorn companies sounds eerily similar. I've not heard anybody talk about that as much. Do you see any parallels to that today, or does it feel very different?
Well, no, I think there are some parallels. Credit is still pretty loose as it was back then. However, this is more credit coming from institutions and banks than it is coming from, venture capitalists and people who are speculating on the market. But having said that, I, as well as many people, including, guys like Peter Schiff, who are, always saying that the sky is falling, we all feel that the stock market is overpriced. It is heavily floated, and it is due for a correction. I'm not saying it's going to crash, and I'm not saying it should crash, but it is overextended. I mean, when you look at PE ratios that are over 20, that's kind of the orange and red zone. If you take out the FANG companies like, Facebook, Amazon, Apple, Netflix and Google, the S&P 500 is really in the red. I mean, these 5 companies are basically holding up the stock market. Yeah. So is that a sign of reality, or is that abnormality? To me, that's not a normal situation. But we're getting more and more calls from people who ultimately become clients saying, hey, you know what? I need to keep my money working for me. I'm scared of the stock market, or I'm overly concerned, so I'm taking chips off the table. I'm pulling money out of the stock market. I'm going to repurpose that or reposition, or what they call rebalance my portfolio, and start putting it into some hard assets. Now, sure, that may include a little bit of gold and silver, but for the most part, they want the hard asset of income-producing assets, which is what we call residential real estate investments. But we're seeing more and more of that because people are saying, hey, you know what? I'm not going to let what happened in 2006 and 2008 happen again to me today, or even in 2001 when, we were in the aftermath of the NASDAQ crash. So there are some parallels. The saying is that history doesn't repeat itself, but it sure often rhymes. So, this is just another one of those events that something will trigger a correction. And if you're smart enough to be out of harm's way, great, good for you. You'll preserve your capital. Maybe you'll double down or 10x your money.
No, I think it's interesting. I think, we had another recording and we're just talking about, similar things between 2008 and 2020. And it's just always interesting to hear, the similarities that seem to crop up. And I think you're saying about the, repeating but rhyming is interesting. I'd not heard that prior. But let's, back again to kind of your story. And as you had people coming to you, I'm also curious, why did you decide to go to this side of providing the turnkey option to people instead of going down that coaching avenue? What was the reasoning for that?
The biggest factor was time. I just didn't have the time. I was too busy looking for deals, traveling to different markets, and basically underwriting my own deals at the time. So I saw a lot of deal flow, and I wasn't buying everything. I couldn't possibly buy everything I was looking at. Now, granted, not everything I was looking at was good. Some of it, actually, a lot of it was junk. Because back then I made the mistake, and this is kind of a takeaway and a lesson for your audience. I made the mistake of wanting to buy cheaper stuff. And you have to differentiate, stuff that's good, that's less expensive versus cheap. And cheap for me back then was buying properties that were in the $40,000, $50,000, $60,000 price range, because they were in low income neighborhoods, what I'll typically call a C- neighborhood. I mean, borderline Ds, D being war zone type neighborhoods. The attractive factor back then was that these were very affordable, beyond affordable. They were cheap. So your down payment was very low. You could literally even buy these things all cash. And, the numbers on paper looked great. The problem is that these neighborhoods had a lot of problems in terms of poor schools, lots of crime, little to no appreciation. And that's one of the biggest factors of being in these low end neighborhoods, is that if you want price growth, you're not going to find it 99% of the time, unless there's something going on like gentrification. But the cash flow numbers look attractive. The cash on cash returns are very high, and that's the draw. But here's where people fall into a trap. I'm going off on a tangent, and I apologize, but when you're involved in these low end properties with low income demographics as far as tenants, you have one turnover. It's often an expensive turnover, and that turnover wipes out your cash flow for the year, and sometimes even more. So you might have good cash flow and a good rate of return, but you have an expensive turnover, your cash flow is wiped for the year. So what do you have left over? You just have the depreciation on the property, which is not very much on a $50,000 property, and you have no appreciation. So really, at the end of the year, you have very little, if anything, in terms of overall gains. And I didn't know that at the time. Experience is the best teacher. I learned that as I was starting to build a portfolio of these $50,000, $60,000 homes. But lessons have taught me otherwise, and now I'm really more focused on B+, A- type neighborhoods, just because I get the biggest bang for the buck. It's the best of both worlds, if you will.
Yeah. Funny you say that, because when we would do a monthly meetup every month for quite some time, and the amount of people and different people and the same people month after month, but I can buy this, why don't you buy D areas? And I'm like, listen, I've done it. I owned, a ton of houses in Philadelphia where I had to knock on doors like this because I didn't know what was going to happen when the person opened the door. And after a month of banging my head against the ground, and Chris would stand right next to me and we would talk about it month after month, I kept saying, listen, do it, this is why, right? There's something we said, risk reward. What are you really getting for 20, 30, 50, whatever it is? Then after literally about banging my head against the ground, trying to explain to people why, cheap isn't always better, I just kept saying, do it. If you're not going to listen to someone that's done it and can tell you the headaches of it, just go do it. Go buy it. It's a great investment. Go buy a D-class property in a D area, and you will see very shortly that you may make a lot of money quickly, but watch what happens when they turn, they don't pay, and then it just becomes a time suck and there's no money involved. So I'm glad you brought that up, because to me, people look at it and like, real estate's expensive. How do I get involved for nothing? That's not always the best scenario. And people have to hear that. And they don't, even if they hear that they're going to have, the candle's hot, don't touch it, they're going to touch it. But, coming from years of experience, I think people, should take that. It should resonate well with them.
I couldn't have said it better myself. Exactly. That's the problem. And the other thing too is if your cost basis is low, getting into these cheap properties, and you want to pull some money out, you may have trouble financing it, because in a neighborhood like that, first of all, you have to find a lender that's willing to do a loan that's $40,000, $50,000, and a lot of lenders don't want to do loans that small. They have a break point. The other thing too is that there's often not a lot of comparables for an appraiser to properly comp a property that you just bought, especially if you renovated it or fixed it up. So you don't have that frame of reference of having a lot of sales comparables, because it's not a retail neighborhood. It's not a retail market. It's pretty much a lot of investors come in, they buy these properties cash, or they bought them a long time ago and they're renting them out, but there's no comps in the area. And so you have a challenge even financing these things. So I just suggest to investors, generally speaking, avoid it unless you already have a large portfolio and you're seasoned and you can put some of that in there just to help round out the cash on cash run numbers. But if you're a newer investor, that's not the place to start. Starting small, quote unquote, no, that's not where you start. You're better off saving a little bit extra, an extra $5,000 or maybe $10,000, and getting yourself a nice $100,000 to $130,000 property in a B-class neighborhood in a very stable market, because you're going to do well in terms of cash flow, and you're going to do well in terms of the average rate of appreciation over time, just because of the inflationary environment that we're in. So that's the place to start.
Yeah, I think it's really important too on the single family side. When people are newer, you look at like what your actual costs per month are. And one of the things that people don't account for is, like you said, turnover, repairs and maintenance, reserves. And those things, you don't have a fixed cost for, right? You don't have a landscaping cost. You don't have a utility cost. You don't have a property management cost. But you have to account for those things. And the problem is when you have a big turnover and you've got to come in and replace carpet and replace flooring and, paint and do different things, it can wipe out the year for you. I just had a buddy who had a single family home, had a turnover, and it's going to cost him like $4,000, and he cash flows like $400 a month. So he's like, this sucks. That's my year. He's like, that's terrible. And I don't necessarily think he did a bad job, but I just think that's part of the risk that you get. Now, the good thing is if there's not another turnover for 2, 3, 4 years, he's going to be cash flowing pretty good. You're going to be $400 or $500 a month. That's not bad for a single family home. So, I think when people start getting into this space, it's super important to look at the downside, which a lot of people don't do and don't take into account. And I think that's why people stray towards the cheaper stuff. They look at the cash on cash and they don't say, okay, how risky is this cash flow? And I think one of the things that I discounted early on, I had a buddy who worked in either like private equity or in Wall Street or something. And he would ask me like what the discount rate is for cash flow. We don't do that. And he's like, what do you mean? I was like, nobody does a discount rate. And basically it's saying like, what's the likelihood that this cash flow is going to come down, and what do you discount it for? So if it's 8% and there's some risk associated with it, is there a 2% discount rate, basically saying that like when stuff goes bad over time, you'll only hit 6%. And I've started been thinking that maybe it's something that should be more attributed, or like something that should be taken into account more, because things do pop up that you don't see or don't foresee. And there should be some sort of metric or thing that helps people understand what that risk is, because especially newer people, it's very tough to understand that and wrap your head around it without the experience like somebody that you has.
Well, here's how you do it. It's very simple. When you are looking at your numbers and you're budgeting your numbers, or you're laying out a pro forma, and you guys know this, you will budget a vacancy allowance, or what some people call a vacancy factor. That could be, I use 5% as a default, and then I adjust up or down depending on the location and the type of property. But generally speaking, you're going to budget between 4% to 8% of your gross rental income as a vacancy allowance, which means that you are expecting a vacancy. You're going to have a turnover where you're losing a good month, a full month of rent, maybe more, but you budget 5%. If you're budgeting 6%, you're basically saying 1 month per year. If it's a lower end area, you budget a little higher. If you know the area through your own research, or your property manager saying, hey, this area has higher turnover, there's just more transient people in this area, budget higher. But you have vacancy allowance built in. Now, granted, you may not spend that this year or even next year, but you factored it in because you know it's going to happen, and you're prepared for it. And that cost is not going to affect you because you've already accounted for it. And the other big one is repairs and maintenance. You have to have a 5% repair and maintenance budget, if you will. Now, again, that could be from 4% to 8%, maybe 10% if your property is older and repairs and upgrades haven't been done in a long, long time, and that carpet replacement's coming up or something like that, you adjust it. But I would say put a minimum of 5% as repairs and maintenance. And you know what? At the end of the month, that's going into your bank account. At the end of the year, if you haven't had a vacancy or any kind of repair, that's all sitting in your bank account. But you've earmarked it for that turnover or for that repair. So when you do that, and those are soft costs that you budget. But when you do that and you still have positive cash flow, guess what? You've got a good investment because you are making a rate of return. You've got positive cash flow and you've already factored in for these events that will happen at some point in time. That's the way to your point, what's your discounted return? That is your discounted return. You've already budgeted in for those events that will happen. It's not a matter of if, but when.
Mm-hmm.
Now the key when someone does that is if you take the money out of the bank and take the bank account to zero, then if you have a problem, you realize you have to put more money in. So, a prudent investor, or what do you want to call, maybe less risk and, more risk adverse or whatever it is, you got to keep some operating money in the account, right? Now, if it's your own house and it's you and it's just yourself, that's the investor, and you run it, a little, separate bank account or through your own, that's fine. But if you take all your money out and you're cash flowing $400 a month, that's great with vacancy factored in, because if it's not vacant, you'll have more money. You just got to have the wherewithal to say, okay, if something goes wrong, my money is either there, but you can't just spend it. Because if you spend it, then you're, discount factor or not, there's no money left in the account. So you have to be aware of that. So when those rainy days do come, you're able to fix issues and it doesn't cost you any money. And that's where I think a lot of people miss it or miss the boat. If your vacancy is right, you have an extra $1,000 in the bank. That doesn't mean you made more money. It just means you made more money. You either leave it there or you know that you're going to have to put it back in at some point.
Yeah, my rule of thumb for that is if you're just starting out and you're buying your first property, make sure you have 3 to 4 months of gross rent in your bank account as operating capital. That's just what you're sitting on, and you use it if you need it. And then as you grow your portfolio, then you scale that back. You don't need 3 or 4 months worth. You can scale that back to 2 to 3 months, and then ultimately 2 months worth. And then if you have it depends on how you structure your entities, but if you have 10 or more properties, maybe you only need about 1 month's worth of gross rent per property, because you're not going to have a vacancy at the same time. You're not going to have repairs all happening at the same time. You've got this slush fund, if you will, of $10,000 of operating capital across 10 properties, and you just tap into it when you need it. But yeah, don't leave the account dry like you're talking about, with zero in it, because then if something happens, you're caught with your shorts down. Now what do? Well, you're going to have to borrow from Peter to pay Paul, and that's not fun.
No.
So
yeah, I think it's important. A lot of people, when they're buying a property, don't even think about having those reserves up front as something to keep in the account. It's just, hey, what's the bare minimum I need to get this deal done? And I just think you're setting yourself up for failure. Not having reserves in places. I just think that one of the dumbest things you can do. And then the other thing people always ask is, how many reserves do I have? And I think it's a good rule of thumb, but I think also what are you comfortable with at the end of the day? Like don't go crazy because the deal has to make sense, but two, what are you comfortable with? And the other thing too, if you go high and the deal is doing well and you're like, hey, we can, cut back a little bit, and you just distribute it, whether it's to investors or yourself. It's just money there. So, anybody listening should definitely have reserves in place for any property you close. I do have a question though, because I've had this conversation with other people. As you build up a portfolio by yourself of single family homes or smaller properties, do you recommend having a reserve account for each property? Do you say have a certain amount in your personal account per each property? Or is there just a total number that you think people should have? How do you feel about that, as people have those reserves?
Well, you should treat your rental portfolio as a business. So it's separate from you. First of all, never hold title in your own personal name, always hold title separately in an entity like an LLC. That's the most favored entity that investors use for asset protection purposes. If you're doing that, then your LLCs have their own bank account, because you have to have complete separation. So it's not just the entity, but you have to have its own set of books and its own bank account. If you do that, then you can store that capital for reserves within the bank account for that entity. Now, you're opening up kind of a can of worms, because you're actually opening up the question of, well, how do I structure my entities to hold my properties? How many, properties do I hold in each entity? Do I have one LLC per property, or do I have one LLC to hold, 3 to 5, or how do I structure that? And that's a separate question. But you definitely need the reserves. You have them in the bank account that's attached to the LLC. Generally speaking, I'm not an attorney, and this is not legal advice, but generally speaking, you'll want your entity to be in the state where you have the properties. And then the question, you'll get 10 different answers from 10 different attorneys, but you can have anywhere from 1 or more properties per LLC. I think it's not unreasonable, but extreme to have 1 property per LLC. Keep in mind, LLCs are very, very inexpensive. It's really the cost of your you have a filing fee every year, could be anywhere from $50, $30 to $150, and then you have your resident agent fee, which is $100 and some per year. So think of it as like insurance. It's just a cost of doing business. So it's not expensive. But the question is, how many LLCs do you want for your properties? And there's different schools of thought on that. But the short answer to your question about having reserves, yes, you need them. Yes, you want them in an account, not your personal account. You want them in your business account. And of course, the revenues that are coming in from your properties that are being deposited into your bank account from your property management company are going into that LLC account. That's where you store your operating capital. And that's where you decide whether you need, $2,000, $3,000, $10,000 worth of reserves, depending on how many properties you're holding in that LLC. I don't suggest you have a whole bunch of properties in one LLC from an asset protection perspective, because you get in trouble with one property and all of a sudden it does become a lawsuit and there's a judgment and they attach it to your LLC. Now it's really attached to all those properties, because when you liquidate one and you have a gain, it's going to go through that LLC and the judgment is there. So, it gets a little more complicated, but that's the gist of it is, yeah, you need it, but keep it separate.
Gotcha. No, I think it's a great answer. I do think the one thing I'm going to do is I'm going to push back a little bit, because I worry, and I've talked to new people, they get so caught up on the asset protection, the structure, the LLC and stuff like that. Guys, if you're getting started, you don't have millions of dollars of assets, you're working on your first or second property, don't get caught up on how it's structured, what LLC and what state and whatever. Work with your attorney, figure it out. Don't get caught up on the structure and the asset protection if it's going to prevent you from doing a deal. It's definitely important. Definitely talk about it, continue to work on it, make it better, but don't allow that to stop you from buying a deal. It's the same thing as analysis paralysis. Don't get caught up too much in the numbers. You got to do it. You got to learn it. It's the stuff you got to do, but don't allow it to keep you from buying a property. So awesome information. I agree with everything you said. I think it's a great place to get started. I do worry that just somebody listening might take that as like, oh, I've got to go figure this all out before I get started. Don't. Go get started, work with an attorney, but don't let it hold you up.
Well, I'm just going to add one more thing to that, because Chris, I've heard that so many times where people have been, I think it's just an excuse personally, but people have held back buying their first property. Often it's the first one, but many times it's the next one, because they have to get all their ducks in a row. And they're thinking, well, I got to figure out, what kind of entity and what state it should be in, and I need to have that set up. And they make this big deal out of something that is so simple. I mean, you could literally, if you don't have an attorney, you could literally set up anonymously an LLC online, through different services, where you have that entity set up before, during, or after your purchase. The thing is you're putting the cart in front of the horse. Damn it, just buy that property with the right team of people working with you and for you. Get that asset. You can transfer that asset to an LLC anytime you want. There's no tax implication. There's no negative to that. All you're doing is you're taking your property and putting it into your entity at some point in time. I like to do it the same day I close escrow when I buy property. I mean, literally it happens 5 minutes later, because you already got the documents signed. So they close and then transfer. But if you're holding yourself back because of that, that's pretty bad. That's not a good reason to hold yourself back. Find the right property, make a smart investment choice, buy it, and then put it into an entity. I mean, you can worry about that anytime you want, but just start investing or get that next property.
Mm-hmm. Yeah, 100%. And when we got started, we did that. We were so worried about structure, format, LLC. I mean, we opened an LLC in Nevada before we ever did anything, and it was the dumbest thing we could ever do. And, we did a course, so it was part of that and part of their sales stuff. So I get it. I've been there. But it's so unnecessary. Like you said, don't put the cart before the horse. So 100%. But I do want to come back to, we started at the very beginning talking about the turnkey stuff. We went back, and I want to come back to it. I would love to hear, and you touched on a little bit, but from you, like, what should a turnkey provider or service look like in your opinion?
Well, if we're talking about level of service, that's critically important. You want someone who's on your side of the table and a team player, someone who understands investing, can answer questions intelligently. They're investors themselves. They have a good understanding of the different markets that, well, let's put it this way. There's not a lot of turnkey providers out there. The ones, I'd say 90% of turnkey providers that are out there are one market. They're based locally, heavily within that one market. And there's nothing wrong with that. That's fine. It's just the nature of the beast. That's how it works. There are very few companies like ours where we operate on a nationwide basis. I follow 504 markets, so I track what's going on in terms of population growth, migration trends, affordability, supply and demand, the economic environment. So that's very important, because you want to start with the market, not with the property. You want to decide where you're investing and for what reasons. And then you work your way down to submarkets, neighborhoods, and properties. So you want to work with someone who has an understanding of the market at a macro level, and then to a lesser degree at the micro level, because once you get down to neighborhoods, those are going to be pretty clear as to where you're investing, because you've defined that criteria for yourself. Besides, you don't want to be in high, upper-end A-class neighborhoods where there is no cash flow, nor do you want to be in low-end C-class neighborhoods or Ds either. So that part pretty much takes care of itself. But you want access to good inventory, quality inventory, stuff that is newly renovated or new construction. And, I'm talking in general terms here, even though everything I'm saying is what we already cover and do and track and offer. But just as far as salient points. And then, another thing too is there a network that you can tap into, a network of lenders that specialize in doing investment loans for investors, a network of property managers, a network of title companies and inspectors, a network of asset protection attorneys, high end, low end, middle of the road, depending on your needs and what you're looking for. Asset protection attorneys, tax advisors are very important as well. And again, there's, premium, high end, low end, and middle of the road cost wise, but also as far as services they provide. So that network of resources is another important thing. Do they have a vetted network of people that they can offer to you? And then of course, for us, those are all important things, but also the properties themselves, because at the end of the day, that's ultimately what you're investing in, and that's what you're going to own for a long period of time, if not forever. So I don't know if I'm answering your question actually, but it's a stab at it.
Mm-hmm. No, I think you broke it down, and I can Chris would have told the world. You told people everything. I mean, it's not just we buy and sell in the same market, but you want to come to a company that can help you out and point you in the right direction. That's doing that research, that's tracking the markets, that knows, hey, you might find the best market in the world. If there's no bank that's going to lend there, you better have a ton of cash. And or if you can't find a lawyer or a tax advisor that knows the nuances of owning a property in another market and filing tax returns if the LLC set up there, there's a lot that goes into that. So having a one-stop shop, that's what a turnkey provider, and turnkey is loosely, that's what that provider should be able to provide, not just I bought a house for 50, I put 20 into it, I'm selling it to you for 120, and I know in 5 years I'm going to have to do the roof and the HVAC, because that's just going to be an added expense in the future. And so I think you did touch on a lot of the things that any turnkey investor should question, whoever their provider may be.
Yeah, that's all true. One more thing that's very important is kind of the soft side of it, or the soft touch part of it, is the communication. Are they responsive? Are they available? Are they able to answer your questions in a timely manner? And are they there for you when you need them before and during the transaction and even after, even though, the transaction's done, you don't need us anymore after the transaction, but we'll stay in touch with you because we want to know how things are unfolding. And at some point, you're not going to just purchase one property. You're going to purchase a second, a third, and a fourth. And that may be one a year, it could be one a month. And we have both of those types of clients. But the communication is very important because I know that's one of my pet peeves. I get really peed off when I try to communicate with someone, whether by email or especially by phone, and they're not timely enough to get back to me. Now, if they're on vacation, that's a different story. But look, get back to me because my time is very valuable and I value my time a lot. So if I'm going to take the time to reach out to you because I am trying to either help you or I want to potentially work with you, get back to me. Have the respect to communicate. Communication is very important. It is my pet peeve. So that's a big factor. And reputation, of course, that's a huge one. Shouldn't overlook that. Having a great reputation is very important in this industry because there are shady operators. I mean, that's true for every industry, but there are some shady operators. And I mean, I can think of 3 of them right now. And unfortunately, a lot of people got taken, like really, rolled over. So having a good reputation is very important because it takes a lifetime to build it and it can be damaged in a very short period of time. So you want to look for that.
So how do you, and maybe this can help people because I think I agree. It's always been a very gray area for me because you're basically buying a property from a turnkey provider that says they've done work and is providing something that should be stable and cash flow. And, they're giving you the numbers, they're providing you whatever. A lot of them also do the management of the asset afterwards. You're basically trusting them that they're not going to screw you over. How do you look at a provider and figure out if they're doing right by you or they even, maybe they're trying to do right, but they just don't know what the hell they're doing? Like, how do you look at a turnkey property or a company and establish that, hey, this is someone credible and worth working with?
Well, Ronald Reagan once said, you trust but verify. Mm-hmm. So, you can trust what people say, but you have to verify it. So, if you've already started working with somebody, you've gone down the road and you're building a relationship and you're asking questions and you're looking at properties to evaluate, that's all well and fine. There's a lot of good information that you can confirm online as far as what they're telling you. There's tools out there, like Google Maps and Street View and Zillow. That's the starting point. After that, if the property is leased and performing and there's cash flow, you can verify the numbers. You can look at a lease and verify the rent. You could look at the utilities if you are paying utilities, which is not very common at all. Property taxes, you can pull that up from the county's website. You can verify property tax. So you can see if the numbers are being fudged or not. So you confirm cash flow, like income and expenses. That's something that is on you to verify. That's your due diligence, but you can do that. So you can verify that. The second thing is that regarding the condition of the property, at a minimum, you want to have a full service property inspector go in. Now, they're generalists by trade. They're not going to look deep into the HVAC system or, deep into the roof. They will make visual inspections, but they'll point out anything that may be a concern or a yellow flag or a red flag. And those are the things you focus on and go a little deeper on. But you're looking for things that are issues, things that must be done, maybe some things that should be done. But that inspection is not something to be skipped. That's the other part of your due diligence. So again, you're working with the provider, a turnkey provider or a nationwide, turnkey company like ours. We're going to provide all that information for you, but we're going to force you to order an inspection. We're going to help validate and verify the numbers. So we're basically doing some of your work for you because we don't want to do everything for you, but we want to hold you by the hand and walk you through. So verify the numbers, do the inspection at a minimum. If it requires another professional to come in, that's another part of your due diligence. The other thing is, what I already talked about, just, doing some research and finding out, what other people have said about working with you. So those are the positive reviews. There may be some negative reviews, but you balance those out and you look at reputation. That's what you need to do proactively. You'll probably eliminate, 80 to 90% of potential problems and risks by doing that. I'm never going to say you'll eliminate 100% of, all potential problems and risks, but that goes a long, long way. And that's really what everybody should be doing, regardless of who you work with.
Yeah, 100%. It's something that we talk about a lot because we raise money from investors for our multifamily properties. And there's been, a handful of times, luckily less than I thought it would be, where somebody's basically unwilling to do their own due diligence or their own analysis of the property and the investment. And I'm like, what are you doing? Like, we're not going to take your money. I remember having one call specifically. We had a property and I was trying to tell him about it. He's like, whoa, stop. He's like, I don't want to hear all that. I said, I want you to tell me if this is a good or a bad investment in 30 seconds. I was like, why would I be calling you, one, if I thought this was a bad investment?
Right.
And I said, two, why would I take your money for something that's illiquid when you won't even take 5 minutes to let me explain what the property is about and to you? And I think it's very important that when people go down this route, that this is not, you are not a financial advisor. We are not a financial advisor. We're not here to tell you what you should or should not be doing. There are certain things in place. And I think people have to take a lot of responsibility on themselves that when they go down this, that, hey, this is somebody that probably has more experience than you, has done this a lot, but you have to have your own understanding to where you're comfortable to be able to really take a look at this and decide, is this right for me or not? Because myself, you, John, I have no idea, what your situation is. Even if you explain it to me for 30 minutes, for 30 days, for years, I'm still not going to have an intimate understanding of what's going on with your finances and what's going on with your taxes and, whatever. One, it's a waste of my time. It's a waste of your time. So anybody that's looking for this, and if you're providing this as well, it's a really fine line between, having somebody eventually as a client and, turning people away. And it's great to hear that you basically force people to do inspections and things of that nature. Is there anything else that you guys do to, kind of weed out people that you don't feel are right, or to help educate people, or, to put people in a place where they feel very comfortable going through this process?
I think because of the volume of content that we put out, a lot of the people that ultimately reach out to us have essentially either filtered themselves out. They've pre-screened themselves. So they either screen themselves in and they reach out to us because they know they're like-minded. They share the same investment ideas, philosophies, and strategies, and they have a base level of understanding and knowledge. So we don't really have to start from square zero. We're starting from square one or two with them, and it just makes it that much easier. So they screen themselves out because they have an understanding of what we do and how we do it. And second, because of the content that we put out, with our podcast, the articles and whatnot that we put on our two websites, they're pre-indoctrinated. They're educated when they come in, and they're asking more intelligent questions, not just newbie type questions, which we're fine with. Someone who's just starting out, we're happy to work with them because everybody starts out knowing zero, and they have zero properties. But as they go, they learn more and they grow. So we'll work with anybody, someone who's just starting out with their first property, or someone who's got over $1 million of investable capital. How we work with them is a little different. What they're investing in is a little different, but we're fortunate, I guess, that people are coming to us and they already get it. They just get it. But that's the beautiful thing of the internet and having a podcast like yours is people can listen to this and little at a time gain more understanding and knowledge. And then when they feel more comfortable, like they have that confidence level, they can move and buy that first property or invest or, participate in your syndication or whatever it may be. Right. So I don't know if I answered your question, man.
No, you did. No, beautiful. No, you answered it great. And I actually think that's an awesome place to wrap up. I know we're coming against time. But Marco, thank you so much for coming on and sharing your experiences. I definitely picked up a few things. I'm sure everybody listening picked up a ton. Where can people learn more about you, your company, get in touch with you, follow along?
Yeah, thanks, Chris and John. I appreciate you asking. So really, we have two websites, our mothership, if you will, where we have Where we post a lot, but not all of our properties, is noradarealestate.com, Norada, noradarealestate.com. And then the sister website is the home of our podcast, and that's called Passive Real Estate Investing. And the domain name or the website is passiverealestateinvesting.com, one and the same. By the way, I will add that there's a book actually coming out named after the podcast as well, called Passive Real Estate Investing. And we're giving that book out for free. It hasn't been published yet, but there will be a free edition or free version of it. So if people are interested in that, as long as you're on our list, we'll send out a notification.
Beautiful. Guys, definitely go get on that. Go check out those websites. If you're too lazy to type it in, go check out the show notes. There'll be clickable links there. But thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, it would also be fantastic if you would send it to a friend, family member, colleague, or anybody you know that you think would get a ton of value out of this episode or past episodes. Marco, thank you so much for coming on, man. This was fantastic.
Chris, John, appreciate it very much. Thank you so much.